So this is chapter 8, which is internal control and cache. So first I'm going to talk about internal control, and then we're going to talk about cache. Internal control. What is internal control? Internal control is defined as procedures which are put in place by manager or the owner of the company or the authorities in the company to provide reasonable assurance that the organization will achieve its key internal control objectives. Now we have a problem because we have to define what are the key internal control objectives. The internal control objectives are to encourage operational efficiency, prevent and detecting errors and fraud, safeguard assets and records, and provide accurate and reliable information, which we already see that accounting information system have the same internal control objectives. Why do we need those objectives? Obviously, for the users to have confidence that the information which is provided to them is reliable, accurate, and on time. Before we talk more about internal control, we have to go back in the history, and this history is 2000, in the year 2000. It started 1999 and to continue year 2000, 2001 affect all the accounting world, and not the accounting world, but all the world around the globe. We're talking about the Enron and WorldCom. So what's happened with those companies? They did something that they're not supposed to do, which later on they found very unreasonable excuses for their action, and that create uh, world crisis. Since then, the authorities or the rule setters sit down and start thinking, what can we do to prevent uh, those practices not to happen again? And they provide some provisions, and that they say that the public company must issue internal control reports. Second is the public company accounting oversight board oversees auditor of the public companies, including the foreign audit companies auditing U.S. listed companies. Also, accounting companies cannot be auditor and provide consulting services to the same client. And the last thing that they did, they create some penalties for those who violate those provisions. The impact to the Canadian companies was that the Canadian company listed on the US stock exchange, they must follow the new rules. Canadian regulators also implement similar regulations and laws, which ensure that the managers give a careful attention to the internal control in their companies. So we're pushing the managers to make sure that the internal control procedures are put in place. The problem with the internal control is, why do we need the internal control? We need the internal control to prevent the fraud and errors. Why the errors? They happen from many reasons. One may be of not knowing the rules and not knowing accounting standards, which is lack of knowledge, or maybe unintentional error. Now, the fraud is a different thing. And in order we to understand the fraud, we have to think about the issue and why the fraud happens. Fraud happens because there's a opportunity, there's a pressure, and there's a realization. Now, which one is what? Opportunity. First, actually, it's not opportunity. Opportunity comes. Yeah, we can say that it comes first. Opportunity is something that we can see every day. Some people can see it, some people cannot. But the opportunity, it might be on there. Now the question is, do you have interest or do you have a pressure from some events which happen in your personal life to use that opportunity? If the opportunity and pressure meet each other, then a realization happens. And that's how the fraud is created or executed, to be exact. So remember, in order to prevent and avoid fraud, first you have to understand, is there any pressure on your employees? Second, what's the opportunity they might see or they might have available? If you eliminate the opportunities and understand the pressure by constantly knowing your employees and what's happening in their personal life, if it's possible, that's how can we eliminate the fraud or realization of the fraud. Next learning objective today with the cache is to list and describe the component of the internal control and the internal control procedures. Business can achieve internal control objectives, which again the control objectives are encouraging operational efficiency, preventing and detecting of errors and fraud, safeguarding assets and records, and provide accurate and reliable information. In order to achieve those objectives, we can apply the following components: control procedure environment, risk assessment, information system, monitoring of control, and environmental control. In other words, when we get in the first letters of all those components, we're going to get the crime. Let's go one after another. Control procedures. Those control procedures are designed to ensure that the business goals are achieved. So that's why it's very important in the first place to identify what's the goal of the business. Obviously, every owner of the business have only one objective: to generate income. For that reason, we have to make sure that we put control procedures around generating that income. Means we have to follow the path from where the incomes come from. Well, income comes from sales minus expenses. So what we're going to do, we're going to put control procedures on the process of generating sales, on the process of incurring the expenses in the company. And those procedures, we're gonna assign the responsibility, we're gonna safeguard the duties, and we're gonna using the security devices to protect the assets. Risk assessment. The company obviously constantly have to monitor and identify the risks in the company, which risks can change based on the environment of the business environment, the environment of the surrounding, economic environment, regulations. So the company constantly have to seek and identify the risks. Information system will ensure that only authorized users have access, and there's adequate approval for every single transactions or journal entry which is entered in the information system. Monitoring of control will be the companies have to hire both internal and external auditors to make sure that control is in place. The environmental control is the last one, which measures the measures in place that help to ensure the business work in the business work runs honestly and efficiently. In other words, lately so many companies putting on their reports that they care about the environment and they care about sustainability. And when auditors start looking for evidence that they actually proactively doing what they say, they cannot find any evidence. So everything which is written on the reports has nothing to do with the reality. So lately, the audit companies, auditors, start paying more attention of what the company says that they're doing for the environment and trying to find out what exactly company did to protect the environment, to protect the sustainability. Internal control procedures. The effective system of internal control has three characteristics. Those characteristics, again, to be competent, reliable, to have the competent, reliable, ethical personnel. So whoever hire the people have to make sure that they hire the competent, the reliable, and the ethical people. We have to have procedure for assigning of responsibilities. The next thing is we have to have in place separation of duties. Separation of duties is we have to separate the custody of the assets from the accounting. We have to separate the authorization of the transaction from the custody of the related assets, and we have to separate operations from the record keeping. The last thing, we have to have a proper authorization. Those are the characteristics for the effective system of internal control. Also, we can have internal and external auditor. We can use the documents and records in order to improve the internal control process. We can use the electronic devices and computer control tools or some other forms of controls which may exist. Now, in the e-commerce and internal control, uh, we have some problems here, and that's related to the technology and the new world that we live in. There's so many viruses and so many people that trying to steal information and using it for different purposes. We have theft, we have stolen credit cards physically or stolen credit cards numbers. So be careful when you're storing the information, either on your computers, either on your account information system. What can happen potentially from those threats? You can lose the entire information of the company. You can lose control over the sensitive data. You can interrupt and even shut down the company completely. You can have substantive financial losses, and you can be even dragged in some legal liabilities without technically being involved. On the security side, how you can prevent from those threats is first to put encryption. You put a firewall in the system, which gonna limit the access to the local network or to the information which is shared through constantly changing the passwords, adding the second layer of security. And we have so many examples lately with how to prevent yourself from information theft. Which are the limitation? Obviously, cost and benefits is the one of them. So basically, yes, you can organize, you can plan, organize, and you can implement the perfect um, internal control system, which protect you from everything. But the question is on what cost? Is the cost that you have to pay for that internal control system is actually justify the benefits that you get from that system? So that will be your judgment, and that's the judgment that you have to make. The other one is collision, and collision represents when the two or more people or employee work together to beat the internal control. Unfortunately, there's nothing you can do to stop that from happening. The only thing that you can hope is when two or more people get involved in the same activity, which is illegal activity, means beating the internal control, eventually they can do that. The next thing that you can hope to happen is they to get greedy. Once they get greedy, uh, one of them is going to expose the other. That's what eventually happens. Bank reconciliation and related journal entries. Again, I told you we're going to do the bank reconciliation next time in class. But before we do that, I can talk a little bit about cash and what's included in cash. Cash, in the definition of cash, we include all the cash on hand, plus the PD cash, plus the cash on deposit in the bank and the trust companies, and cash which is invested in treasury bills. Usually, those treasury bills are with for the period of no more than 90 days. Now, the cash is the most liquid asset of the organization, obviously, because easily can be transferred from one hand to another hand. And cash liquidity can be considered a disadvantage because it's the most easily to be stolen and the asset that you can easily lose because of its liquidity. How can you ensure that the cash accounts are under control? Since the cash is the most liquid asset, can be concealed and easily moved, So that means we have to put a special internal control procedures on the cash. How can we do that? We can, as a control, we can use the bank accounts, which including the signature card, deposit slips, checks, bank statement, uh, bank reconciliation is another way we to have control over the cash. Checks. First, on the checks, how many of you actually write a check? Is there anyone who hasn't write a check? Let me paraphrase my question. Do you want me to bring you checks so you can see checks next time in class and actually write a check? Simple yes or no is going to help.
Yes.
Yes,
Yes.
Prof.
Okay. Okay, let's do that.
Yes.
So next time I'm gonna bring you some checks and we're gonna talk about and we're gonna see what's on the check, what's the requisites on the checks, and what kind of procedure we can put on check in order to protect the most liquid asset, which is the cash. Bank reconciliation. We're gonna spend more time on the bank reconciliation next time. I'm not gonna spend anytime today. I'm gonna move to the next objective and how we're going to apply the internal control to cash receipts and cash payments. So, the, in order to protect the cash, we have to understand from where the cash coming from and where the cash is going. So, the cash coming from cash receipts and cash going to cash payments. Cash receipts, when we receive the cash, that's because the sales was generated. When we paying the cash, is not because of purchase of assets or uh, inventory or any other expenses has happened. Now let's see the process. First, internal control on the cash receipts has to ensure that the cash receipts are deposited quickly for safekeeping. What that means, the cash receipt over the counter. If we get the cash over the counter, what we have to do? We have to have a cash register, which has to be positioned so the customer can see the amount the cashier enter in the terminal. Receipts has to be issued after each sales record. Cash draw should be only and only when the clerk enters the transactions. And obviously cash needs to be deposited in the bank. And the machine tape goes with the accounting to record the daily sales at the end of the day. At the end of the day, or when we're changing one cashier with another cashier, the cashier has to run this record from the machine, from the cash register, and submit that receipt with the cash, with the total cash, to the supervisor. He to check is the cash that shows on the receipt equals the cash that's sitting in the cash register. Second option is the cash to be received by mail. Surprisingly, there's a number of checks. There's a lot of companies that are using this practice. Basically, companies sending to each other checks in the mail. So there's a lot of checks that come in the mail. So when that happens is all the incoming mail has to be opened by the specifically identified employee. The treasurer he has to do the cash deposit in the bank. Remittances advices and the record of the payment has to go to the accounting department. The controller of the compares the record of the day cash received to ensure that they match. And some company using even a lockbox system and the receipts are directly sent to the box belonging to the bank. which directly deposit to the customer bank account. How are we going to do with the cash short and over? Obviously, when you have a cash register, by the end of the day, when you're comparing the record from the machine, from the cash register, and the money which is sitting in the cash box, cash registered box, there might be a difference. When the recorded cash balance exceeds the cash on hand, we have obviously cash short situation. When the actual cash exceeds the recorded cash balance, we have a cash over situation. For that reason, an account that accumulates the differences between the actual cash received and the cash record is created, and that account shows the cash short and cash over. And we're going to debit and credit that specific account. The net cash balance is shown as cash over in the income statement, and the large balance of the cash short and over signals that there's obviously potential of internal control problems. Let's see this example. Now, let's suppose that from the cash register, when we run the report, we're supposed to have a sales revenue of 15,000. But once we actually count the cash, we count $14,980. So that means we're $20 short on cash. So what we're going to do? We're going to record our sales of 15,000. We're going to record the actual cash that we have available in the cash register of $14,980. And we're going to debit special account, which is called cash short and over, $20. Now, if you want to prevent that to happen, call the cashier, have a conversation, and start monitoring the cashier. Now, what will be the internal control over the cash payments? Well, payments by check is important internal control because the check provides a record of payment. Check must be signed by the authorized official, and the signing official can check the actual invoices and ask for the evidence that this expense actually happened. For that reason, I strongly recommend you, if you go to the company or if you want to open a company, in order to have control over the payments, don't set up direct payments. Somebody to take the money directly from your bank account. No. For every payment, write a check. And when that check goes through your hands and when you sign the check, you know exactly what you're signing and you exactly know for what you're spending your money. Otherwise, you won't know for what you're spending your money. So, the purchasing and the payment process follows those steps. First, we can prepare the purchase order to the supplier. The way I show you that when we're talking about the accounting software system, I told you that in the purchasing the inventory or purchasing of the supplies, first thing is to prepare the purchase order, which is sent to the supplier. Second, supplier ships the items that you order with the purchase order. They will contain the items in the purchase order to make sure that everything is received. After that, the supplier sends the invoice by mail. And then the receiving department checks the goods and complete the receiving report. Now the accounting department checks and confirms that all the documents, purchase order, invoice, and receiving reports are correct. and then the check is issued. In this case, we have the three-way match. First, somebody confirms that the items are ordered. Somebody confirms that actually items are which are or ordered are actually received. Somebody confirms that the item that are on the invoice was actually purchased and actually received. And then you sign in the check and make a payment. This is the control picture of the payments, purchasing and payments. So we have the purchase order, which is sent to supplier. Supplier send the inventory or the shipping with the items and the purchase order, and sending separate the invoice. Once everything is approved, company that received the items and the invoice send the check to the supplier. How are we going to deal with the PT cash? PT cash is something very specific, so we can deal with the PT cash next time when after the bank reconciliation I can explain what the PT cash is and how we can deal with the PT cash.